I hope they're right and I'm wrong, because if not, they have a big problem. All rallies, all bull markets, they have also major corrections. Maybe gold is the one that is wrong, and it needs to go and take another leg down. Deflationary bust that I see unfolding, and with a strong dollar coming out, is going to create a lot of havoc in everywhere.
Hello, welcome to Crux Investor. First of all, thanks so much for watching this video. If you like it, give us a thumbs up. It'd be much appreciated. And do leave your comments below. I'm sure there will be quite a few of them for this one. Helps us understand the sorts of questions you think we should be asking, how you think we did, and of course, what you thought of this particular interviewee. And if you want to catch this as a podcast or read about it in an article or transcript, you can get that at cruxinvestor.com. And of course, for our Crux Club members, you get early access to this video. And if you haven't already done so, please click the button in the corner of the screen to subscribe to our YouTube channel. And for more videos like this, click the notification bell. We spoke earlier today to Henrik Zeberg. Quite controversial guy. He has recently been lambasted for suggesting that gold may fall to $800. We find out why he's saying that. Where's the data? Where's the evidence? And he kind of runs through his thesis, his background, and why he's probably actually quite aligned with most people. So quite an interesting topic. Take a look at the description below. Some of the other things we discuss. Anything particularly interests you, click on the timestamp. That's the number beside the topic. I'll jump you to that part of the conversation, but I would encourage you to listen to the entire interview with Henrik. Do enjoy. Henrik, how are you doing, sir?
Thank you, I'm good. How are you?
Yep, all well. Where are you? You're in Copenhagen, I think. Is that right?
Copenhagen. The weather's nice here, and people back on the streets and back in the cafes and everything. So it's all fantastic.
Beautiful. Yeah, beautiful city. Been a few times, but not recently, obviously. Yeah. So tell me a little bit about you. So if you're from Copenhagen, you've always worked in Copenhagen, or have you ever had the chance to come to London?
I'm from Copenhagen. I'm always from Denmark, but I've lived in Copenhagen for the last 26 or so years. Haven't been working in London. Would have loved to do so. It's a fantastic city and many great places in the world, but this is absolutely one of my favorite places. So what do? I do actually work as a consultant, but I have this. I have the financial markets. I have macroeconomics as my something that is very close to my heart. It's something that I am very interested in. Something I use a lot of time in studying and understanding. I do have my website with my service, which is called the Zebergreport.com, where I on a weekly basis do a podcast, a live show where people can ask questions on markets and how I see where I see the world going in terms of financial markets and the macroeconomy. So this is what I do.
Okay, fantastic. Well, the reason I want to speak to you is because I listened to a podcast recently. You were talking about gold, which I want to talk about in a second, and the reaction was extreme in the sense that a bunch of people who agreed with you, and there are a lot of people who didn't agree with you. You're the kind of like it's the Antichrist. It does not serve their narrative for you to be talking or affecting sentiment in the market, saying what you were saying, and the thing you were saying, which was, I think, quite incendiary to them, was you see $800 gold before you see gold going to the heights that you think it will eventually get to. But perhaps the headline there was the grabber, the $800, as opposed to the bit where you actually agree with them that it will rise and we will get past the highs of 2011. So do you want to tell us why you said that? Why $800 gold and why you think that?
So first of all, I base all my forecast and the way I perceive markets on a model that I built, which is based on an understanding of the long-term perspective in markets. So where are we? Are we in an inflationary kind of environment, or are we in deflationary kind of environment? And most people will say, well, we're perceiving that or looking at that from a 3 to 6 months kind of perspective. I'm looking at that in a 20 years perspective, from a contractive wave perspective. So for the last 20 or so years, since year 2000, it's not an exact science or exact date or anything, we've been in an environment where the debt in the world has been putting a lot of pressure on growth. And that has created a deflationary kind of environment where the pressure is downwards on prices, which is why the central banks cannot get inflation going. And that is in alignment with what Kondratiev has been put out in terms of his Kondratiev winter, which I think is where we are at. And this is also what we have, if you study back in history, where you've seen, similar debt levels build up, you haven't been able to produce the growth, and then you will have this kind of environment, which lasts for quite some time until the intelligent politicians understands that what you really need to get out of is get out of the debt. You need to eliminate debt or get it reduced to get growth back on, real growth to spur. And in this world, in this kind of environment, you'll see central banks print like crazy. And this has been done before. It's not the first time in history. So they will print like crazy, and they will try to see if they can spur growth by doing monetary stimulus. In this world, of course, gold supposed to rally and rise, and it has. If we look back in 1999, which was the bottom, gold was at 250 or so, and today it is at 1760. We've been up and touched 1920 back in 2011, but all rallies, all bull markets, they have also major corrections. And if you look at what I see since 2011, so looking at from 1999 until 2011 was the major bull market. It was a 5-way move up. And then you had something from 2011 until today, which is actually, in my view, a correctional move. So the decline until 2015, which was then, and then we had some kind of a bottom, and then we have another rally up to now. And then in my world, in the Elliott wave world, you simply need another decline. And what is supportive of that? Now, let me finish by saying that. And that kind of decline we're going to see there is going to be quite powerful, because it's going to be what I call a wave C, and it's going to be quite extended. And this is based on Elliott waves. And then if I look to other markets and say, okay, what does silver tell me? Silver didn't peaked after the bottom in 2015. It actually peaked in 2016. Hasn't had any high since then. Miners, the same kind of thing. If you look at them, some of them, of course, but if you look at the GDX, it seems like some kind of bear flag is being put in. So I'm just saying that maybe if you look at everything else, and they seem to suggest that 2011 was a major high, and then we have some kind of correction, maybe gold is the one that is wrong, and it needs to take another leg down. And what should be supportive of that? Of course, the strong dollar thesis. So in a deflationary kind of environment where we're going to see, sell off everything, a strong dollar is going to bring gold down. So Elliott wave tells me the deflationary environment, of course, will bring out gold at major highs, and we're going to see gold come to a absolutely extreme high at the end of the Kondratiev winter. But the road to that high goes through the waves that I see in Elliott, which tells me that we see another low, and that one should bottom out around 890 or something like that. 900 would also suffice. So somewhere around there.
But
long story. Sorry.
No, fine. No question. There's a lot in there. Okay. You're an economist. That's your passion, that's your hobby. You've got a podcast once a week, right? You've chosen to spend your time doing that. Why are you interested in the commodity space? Of all the things that economics covers, it impacts everything that we do. So why commodities? Let me understand that first.
Yeah, sure. Because to me, it's I'm a long-term kind of investor, so I'm positioning for the long term. I think that's how to generate real wealth, and if you do not want to get too stressed by day trading or swing trading. And positioning for that requires that you understand whether the market is inflating or deflating in the very long term. And the commodities actually tells us that. So if you look at across the board charts of commodities, you'll see that they will give us a story. They will show patterns of either a bearish pattern or a bullish pattern on the, for the next 1 to 2 years. And that will tell us whether we are in the moment where we need to get long miners, or we're going to go long equities. There will also be a fantastic moment at the end of the Kondratiev winter, where equities will be at a fantastic value, which I absolutely do not think they are at this moment. So to me, it's the deflationary, inflationary kind of understanding. Is the world inflating or is it deflating? That is important in terms of understanding where to position my long-term funds.
Okay, and so part of what you do is actually you are an investor yourself, so you're looking for opportunities in this. And I know you're studying gold. You've made statements about where you think the price of gold, what it will do, depending on what the market conditions are. So you think you can make money there? I mean, is it something that you've studied for long? I mean, how long have you been sort of, trying to understand the way that the gold market moves? Because, it's the market's one thing, sentiment is another. You've got also the impact on companies. The producers. If gold goes to 800, clearly not too many people making money. There will be some, but not very many. And that has a big impact on a company's ability to survive, which itself has a knock-on effect in terms of how much production there is or can be, in a very, very short time frame. So if the market does what you say it does, what type of betting are you doing? Are you shorting against these companies?
No, I'm not shorting the companies. I'm not. I have a list of 15 companies that I've been studying. I've from a fundamental and technical perspective, and I got some fantastic entry points that might seem extreme to some. Some of them are the large ones, so Barrick and Newmont and others that will, in my world, the way I see it, will drop to quite extraordinary low levels before we see the bottom. And so I'm patiently waiting for that. I am long dollar onto that point, because as I see it, the deflationary kind of world that we have is going to create a fantastic environment for the dollar, simply due to the shortage. So I'll be waiting with the kind of funds there. Am I missing out on some rallies or some bull kind of moves in equities or other places right now? I might be, but there is a lot of risk also by getting into stocks at this point. So to me, it's about playing the deflationary, inflationary game of the environment, understanding that, and then having the cash ready for the real moment. So I'm not trying to short the miners. I'm having this is what is most up on FinTwit, but I have what I would call a speculative position on gold, which I'm monitoring. I'm trying to see if I can get in and get a ride on the short side of gold. But is it now? Is it here? No, I don't think so. I think we might move a little higher first, but that's more speculative. The money that I have is invested in something that is quite exposed to the dollar. So that's how I play it.
But those are equities in companies. You're not talking ETFs. You're not talking royalties. You're investing in gold companies, not physical gold. Or are you investing in physical gold?
Not yet. Yes, I have physical gold also. Yes, I do, of course. And everybody should have some. But I'm not investing in that yet. I'm not investing in the companies yet. I do have, as I said, a list of companies that I will be investing in at the point. But I think some of them, and as you said, they're going to suffer tremendously. Some of them, I think some of them from the current levels are going to drop 80 to 90%. Before actually hitting what I see as the bottom. There is this massive deflationary bust that I see unfolding, and with a strong dollar, coming out, is going to be, create a lot of havoc in everywhere. And if I look across the board with the commodities, and I do not subscribe to the idea that gold is different from any other commodity in the world. I mean, silver and gold and palladium and platinum and others. If I look at them, it still seems to me that there is another low, much lower low, and that is the game where, of course, I want to get in at that point, because by the end of the contractive winter, gold will be in a fantastic bubble. It will be at $5,000 or $6,000 or $10,000 per ounce or something.
So I get what you've said so far, but What I'm not hearing is, or not understanding is that, how do you understand the fundamentals of the companies that you want to invest in? But given it's not necessarily going to be about, physical gold or gold ETFs or any other type of gold, it's equities in companies that you think you can best take advantage of. So how do you understand the business fundamentals? Do you just looking at financials, or are you capable of understanding or looking at the geological technical component to this? Because there's a lot of risks when you're investing, right? So what are the core bits that you're studying?
The core bits I study is that I look at I have been studying companies throughout my career, also a consultant, and to understand the solidity and the of the company. So I've done the same here. So to understand what kind of, from a financial perspective, from financial statements, and from what I've seen, I do not have any understanding or any knowledge of, their geological tests or anything like that whatsoever. I base it on what I see, but that information is built into the charts as I see it. So in a world where, people like yourself or many other people that have great understanding of just that, will be, putting that kind of understanding into the charts, and when millions and millions of people are, investing, we will see patterns emerge. So I'm trusting the patterns that I see, and I try to follow that. But of course, I look to the solidity and the soundness of the individual company to understand whether there's something I want to invest in. And then I build a portfolio where I see, okay, there is the bigger ones that will be the more stable ones, and then there are some which are smaller, which will provide a fantastic upside.
And so I'm not a charterist or anything. I kind of invest in management teams and companies, and I try to understand as much as I can about that. And clearly, I've got to have a macro thesis about whichever commodity. Okay, so I don't subscribe to the just the pure data only. There's a kind of emotional component to this. What you're describing, there seems to be very little emotional component to it. It's data driven. But is there any confirmation bias in the way that you do this analysis? Do you have a sort of a predilection for a certain scenario, so therefore it affects your interpretation of what this data tells you?
Sure. And I think that's the risk of all theories and hypotheses. It is that, of course, if you have a certain way of looking at things, it might influence the way that you are actually analyzing things. I definitely buy into that, and that's why I try to test my thesis, all over with everything I see. So if I test it with, for instance, the gold bulls, the ones that I'm also a gold bull. Remember, the ones that saying, okay, so gold will rise to about 2,000, 3,000 from here. Still need to tell me why it is that silver put in the top in 2016, and then have, okay, what do you say that, has had a bottom this year, 4 years later, or 5 years after when gold bottomed, we had a silver bottom. So there are things that where, if you look at that from that kind of perspective, the thesis that I'm putting up is the one that has the fewest things that it cannot explain. The thesis that gold is going to rally from here is the one that needs to tell, why is it that miners haven't rallied? Why is it that we haven't seen silver supporting this? Why is it that we have all the commodities that I look at in a very bearish patterns as I look at it? And I believe in patterns, because back to what you said about the emotional, I believe that everyone that invests in the market is going through the same kind of cycle. So we become over optimistic and over pessimistic and over optimistic. So we go through this cycle all the time when we're doing the analysis and we invest our money. And what happens is that, if you take the accumulation of that, of millions of people doing that, then you actually start to see patterns. It's like birds in the sky. It's like, fish in a crowd, and you can see patterns in what's happening, because we influence each other in what we do. And that's why if you have numbers and big numbers, you will actually start to see something which come out as patterns. So the emotions are actually built into those to the ways that I look at it, as I would say. So in terms of having a bias on it, yes, you could definitely say that. But that's why I try to expose it to as many counter arguments as possible on a weekly basis. But I have to say that when the structures have been laid down, so if you have something of a structure which is in an ending diagonal, for instance, which is one of the powerful bearish patterns that I see in many commodities, chances are that they are going to fall out like that. I had the call back, I remember it's a year ago only, that we had oil at 80 or something like that. And I said, I think it's going to drop below 20 and perhaps below 10. And I was called crazy back then because, no, why? And how should it now, and that's back to the inflationary, deflationary world. But in my world, the structures of what we had for oil was the bearish structure, and we're going to stay low. And that is because we again act as human beings, as individuals, but when we act as in a crowd, we're just another lemming, like trying to get out the door when it starts to get hot or something like that. I mean, we are emotional people, and we will be influenced by others. So we need to look for the structures to understand where we stand.
Okay, so interesting point you just made, the way that people behave. So if I look back to March when we had that massive fall off the cliff, there was a market reset and just the onset of COVID, etc. It was, by definition, the perfect time for contrarians, people who like to call themselves contrarians, right? And some people dipped into the market because that was their belief system, investing belief system. So many didn't, because they were either trying to find the bottom.
I didn't.
Okay. Yeah. Trying to find the bottom, or just when the rubber hit the road, they were too terrified to put their money in because they didn't know where the end would be. Okay, so that was a belief system which I saw fall apart when it came time to put your money down, right? Do you ever worry that you are getting it? So you haven't invested yet, right? You haven't put your money in because it's not the right time.
No, I'm exposed to the dollar 3 times, the whatever it does against the euro. So I mean that's one of my major positions, and It's been great since 2016. So it's been great, and I think it'll do a lot better this year. So I am exposed. I am invested.
Okay.
I'm just invested into what I think is the dominating force right now, and I can see the dominating force is a strong dollar in this kind of environment that I see. Do I want to invest into something where we have a market cap to GDP at 129? No, because that's not investing. That's speculation.
Okay, you're doing a bit of FX at the moment, but I'm talking about when it comes to actually you're selling. You're a consultant. You've got your podcast show that you do. I don't know how you drive your revenue, but you're saying to people there are going to be at least 15 companies that you have identified which you think investors will be able to make a lot of money in if they hit it at the right time, and you're going to clearly put your money in at the same time, right? Are you at all nervous that you'll get it wrong?
Of course, and then that's why we all get nervous that we are wrong. Of course I am. But I as I said, it's about probabilities. It's not about, and there's no certainty in this, of course not. It's about probabilities. And if you look at the one thesis that requires the least excuses, so to speak, that's the bearish thesis for gold. And I know that's counterintuitive to a lot of people, but it is the bearish thesis because it doesn't have to explain miners, it doesn't have to explain silver, it doesn't have to explain platinum, it doesn't have to explain a lot of things. And that's why I think I would love to go long gold. I would love to be long the miners now, because I can also understand the narrative or the understanding that Fed has gone rogue. Every central banker in the world are printing money, and we are, as part of my thesis, as part of my contractive winter, we are going to see the runaway from fiat currencies. I'm just saying that the structures that I see is not a bottom. So what you look at from a gold perspective, for instance, a structural perspective on gold, the kind of rally that we see coming off that bottom is not a bull market start. And you can say that for a lot of commodities. And if you then look across wheat and rice and all the commodities that tells us whether the world is inflating or deflating, and also subscribe to the idea that I have, at least, that gold is doing well in an inflationary kind of world. I mean, some people tell us does well in deflation, and then they'll point to the 30s. But if you really look at it and you study it really hard, you'll see that in the deflationary part of it, it does not do well, because that's where cash is everything. That's where the dollar is everything. So am I worried sometimes? Yes, of course I am. I put a lot of faith in what I've done here, but then I test it and I test it and I test it and I test it a million times every week with different perspectives, try to falsify it, trying to stay away from, but that's of course, difficult, but confirmation biased, but trying to say, well, what would I need to see in order to actually have to change my mind? And I haven't seen any of that yet. And just pointing to a price level and saying, okay, I'm being asked this a lot. So which point in gold, which level in gold would you say you're wrong? I would say, listen up, guys. First of all, when gold is starting off in its bull market, it's not going to take 5 years to go from the bottom of that, from the absolute bottom to surpassing the all-time high. It's going to take 4 or 5 months. So and in terms of Elliott wave, it's also, it's a clear B wave where everybody gets in on the wrong side before getting annihilated, and that's why they'll miss out on the bottom. So am I worried? Yes. Am I so worried that I need to change my mind? No.
What do you think when you see $5,000, $10,000 gold coming and it's imminent, and from some pretty big names, right? And everyone talks their playbook. Yep. I get that, but what are you thinking when you see that? You go, I'm better than you. I've done my homework. You don't know what you're talking about, or you're just going, we're in violent agreement. It's just a question. I think there's going to be a quick correction before that happens. I mean, what are you thinking?
I'm actually thinking, I hope they're right and I'm wrong, because if not, they have a big problem. I mean, I'm sitting here doing this, with the kind of framework that I've been putting up. So I fully buy into the 5,000 and the 10,000 gold. I do. But I just think there's going to be something which is going to be a decline. It's going to be very swift. And you can still be right. I mean, you can still say, well, it's going to go to 5,000. It's going to be a fantastic investment over the next 3 years. Yes. But it's going to be an even better investment from 890 or something like that level. And it's a 50% decline. Can we have that? Well, if you look at rice, for instance, as I pointed to 2 weeks ago, it dropped 48% in two weeks. I'm just saying, yeah, but this is gold. It's different. It's different. Well, you can look at I think it was silver, which in the course of 4 weeks, three and a half weeks, it dropped from, was it $18 to around $11 back in March. So I'm just saying, maybe, if I'm right, maybe we can see a very, very swift move down. And I'm not suggesting we're going to be there for years or for months or weeks even. I'm just suggesting that we could see a fantastic sell-off. And the reason could be many. I could see it, I could see it in a bullish environment for equities. I could see it in a bearish environment. I would have to say that my preferred scenario is a major sell-off where everything will be sold off simply to get dollars in a kind of, we don't have that sentiment right now. That's why it's so difficult. But back in March, it wasn't so difficult to get that feeling. So what am I thinking when these big names says this? I think they're right, but I think their path will not be right. And I am sticking to the 30 plus 50 charts I got, which points to a deflationary kind of environment. And then I'm saying, no, gold is not going to decouple from silver. And there's no, and still we cannot have an environment where gold is bottoming in 2015 and silver bottoms in 2025 years apart. It's simply because in my world you can have different kind of correctional patterns, and gold shows one of them, which is due to the got gold thesis and the got gold sentiment that you got in the market. So everybody gets it. And then and silver has more of the triangle kind of the correction, and it needs one more low, and gold does the same, as I see it. So they are probably a lot wiser than I am. Probably they are definitely, but also a wise man can be wrong sometimes.
Yep, that's true. Talk to me about hedging, because again, there's another conversation going out there in the marketplace with all of this quantitative easing. With all of this money being printed, there is an imminent crash coming. Okay, the question people are arguing about is, when is it coming? Not if, when is it coming? We are printing money like it's going out of fashion, right? So something is wrong with the way we're trying to tackle the problem. It is exceptional times with COVID, but even so, the problem doesn't go away because of that. So we've been talking to various people who are saying, well, you should buy physical gold because it's a store of wealth, it holds its value, doesn't do anything, and it can't be affected by anything, right? And you know, a lot of people buy into that. And there are other people saying, well, you need to spread the types of investment that you make. You need to, you know, be sure that you're not going to lose all of your money because, you know, for whatever, whether it be deflation or inflation, it's not good for your money. So, what's your view on hedging, and what sort of hedging would you do? I mean, I know you're talking very aggressively about investment in certain gold companies because of what you believe is going to happen there. But what else are you looking at?
I have to say, in this environment where you have the bond prices at what we have, the rate levels at what we have, and we have equities at the price levels that we have right now, I don't see a lot of value in many places. I think bonds are going a lot higher, but it's again with the kind of rates that you get now, it is there is very few places actually to be at this moment, and that's scary, and that's why you probably have that equities will also go up a lot because everybody's getting in and say, well, it's going to rally, and then people are getting in. And if you look at PE levels or you look at whatever for kind of soundness to this. Would I have some of that? No, not at this point. I would rather, wait out. And I think that is, the fear of missing out is what a lot of people is falling into here. And then they say, well, you need to have some, or you need to be part of this. I'll say that, it's better to have, sometimes it's better to get 0% in return than trying to get into something which is a very risky environment. And for this moment, I think that the kind of fallouts that we can see are going to be so great that I would be, fearful of holding too many assets at this point. There's so much that could go wrong in different in the kind of economic environment and financial environment that we have here. So, but of course, I would say U.S. TLTs, bonds would be a good thing also to hold. Would I hold them right now? Maybe not, because I think there could be a spike in rates for some reason. But of course, I think it'll move much, much higher. I think we're going to see negative rates on bonds, US bonds as well. And I think we're going to, and we'll see, and that could be, of course, a way to position yourself. It's not really my game. It's not what I want to do. I think the long dollars to me is going to make it, but long bonds would probably be one of my preferred trades if I had to do something else also.
Okay, interesting.
US bonds and it could also be bunds, German bunds or Danish mortgage. I actually do have Danish mortgage bonds as well, which is same like the German bund. So quite strong. We got a strong economy here in Denmark, so it's something that I also hold.
Okay, what have you learned along the way, right? So what are the mistakes you've made? What have you learned, and how does that affect your thinking today? Well,
I think what I've learned, for how long I've done it, I've been in markets since 2005 or something like that, so and been heavily investing since then. What I've learned is that you might be right in the long-term perspective, but you can be very wrong in the short term, which is what I've been seeing in so 2019, for instance, where the oil call that I had when oil was at 80 or something, and I said, well, it's going to go below 20, it's going to go below 10, as I said also back in January, and everybody was calling that crazy. I think 2019 was a bad year because oil was going sideways, and then a year down the road, boom, we got this major decline. Which was consistent with the structures that I saw. So, being right is not the same as being wrong is not the same as being right, and being right is not the same as being wrong. I mean, it depends on the timeline here, and that's what is so important, is to say, what is it that I'm really aiming for? Am I aiming for the next 1 or 2%, or am I aiming for the big trade? And what I'm looking for is that I'm aiming for something that is life changing, and I can, in this kind of environment that we have right now. We have so many opportunities to do life-changing things. I don't care about 3 or 4%. I care about 500%. And then people say, well, how could you even suggest that? Well, because if you look at the miners, for instance, when they hit the bottom in 2008, and they started rallying for real, that was not 4 or 5% or 10% or 20%. That was way more than that. So it's about getting in at that point, understanding the macroeconomic environment, understanding when have they been squeezed down below the floor, and then you can get in there. And there are others, of course. If you look at oil companies at this point, if you look at Halliburton, for instance, I think there's going to be a major low. There are some of them that I look at as well. Fantastic opportunities. Would I buy it right now? No, because I think they can half in price or more than that before we get to the absolute bottom. But in the secular bottom that I'm calling for this, all my commodity charts tells me that the inflation is going to get to a secular low, meaning that what we had in 1982 was a secular high, and then we have had this long period of time where we've seen rates being going down. This secular low is what's going to be really defining for a lot of people. It's going to be defining in terms of if you get in and you fix your mortgage rate at that point here in Denmark, at least that's going to make a lot of money on that. If you are going to get into to miners, if you buy gold at that point, if you buy a lot of things, then we're not talking 2.5 or 10%. We're talking about way more, and that's the kind of game I want to play for. That's where I think that you get in and you hold on to that position because you're moving on the great cycle. You're moving on the great, and it's not so stressful either. So. That's what I've learned. That's what I still go with. That's what I still think. But it requires that you also have something on the shorter term time frame that generate the money on the shorter term time frame. And that's where there are some very good guys out there who does short term trades, and I'm trying to become better at that as well. And I got some techniques that are starting to show some good results.
Fantastic, Henrik. I thank you for your time today. Appreciate you taking time out of your day to talk to us. So if people want to know more, what's your URL?
Well, it's the Zeberg report and .com, and it's Zeberg. It's CEBERG, and then report.com. So please tune in there. What I'll do is I will have a live show every Sunday where I'll go through the charts. I'll try to connect the macroeconomic environment with the charts, trying to do the cross-market analysis to show that it's not just about one chart. It's not just about gold. It's not just about silver. It's about understanding it across the table and trying to figure out what is it actually the kind of move that we see. Is it a correctional move? Is it a main move? And then understanding where to get in and where to get out.
Thank you for your time, and we'll hopefully speak to you sometime in the future.
Thank you very much.